It is Friday, April 6th. Welcome to TechTO Quick Takes. I'm your host, Alex Riley, and we are broadcasting this week's episode live on LinkedIn, Twitter, Facebook, YouTube, and Twitch. As always, we want to hear from you, so drop a comment, share a like, and send us your feedback wherever you're watching or listening, and share your takes as well. So today's headlines: Neo proves that Canadians want neobanking, Shopify expands into delivery to better challenge Amazon, and Bonsai proactively focuses on the future by cutting a third of its team. So I will bring up Alex Norman to
Hey,
help review.
Alex.
Alex,
How
hey,
are you?
lots to unpack. So why don't we start with the Neo news and how they're creating value in Canada?
So, actually, I would, now that you hear the title again, I'd probably rewrite it to something like Neo proves how to get a wedge and grow big. Um,
Okay.
so Neo Financial, which is, out west, or, has reached 1 million customers in 16 months.
Mhm.
How they do this? By finding a unique wedge to acquire customers affordably, and then they start expanding their product line to better monetize customers.
And how have they managed to acquire customers so effectively?
So Neo, their initial wedge or customer acquisition tool was the one place where Canadian consumers probably switch financial institutions often. If you look back historically, Canadians are known to stick with their bank for generations. My father was a TD Bank user. I'm a TD Bank user. My daughter's a TD Bank user. So instead of Neo going head on saying, "Hey, let's start with a checking account," they focused on co-branded credit cards with a generous loyalty program. What they did was they partnered with a bunch of large national brands and 7,000 local retailers to offer a joint loyalty rewards program and paired that with co-branded cards that leverage the program. So, for example, if you go maybe into a Home Depot or the Hudson Bay,
Mhm.
they might have the Hudson Bay Neo Financial Card, which has a loyalty program, which lets you get points which you can use at Hudson Bay, or 7,000 local retailers. And so, how this kept customer acquisition low is instead of having to advertise on Facebook or Google, these retailers promoted the co-branded cards in store, and they've now been, as they scale, Neo Financials using traditional um, marketing channels that are more cost effective to leverage that co-branding opportunity. So they have malls and kiosks.
Mhm.
Second thing is this program appeals to customers who want to shop and at national stores and support local retailers by having a loyalty program that encompasses both. They've got a program people find out about when they go shop at one of those stores, and then they see this is a pretty interesting program. So they've acquired quite a few customers really quickly and cost effectively using this strategy.
And how have they continued to expand the value for its customers?
So start off with the credit card, and
Mhm.
they've been layering on additional financial services so it can be a one-stop shop for your financial needs. They've launched a savings account, which is provided by Concentra Bank. So it's a Neo savings bank, a savings account, but it's part the back office and the actual products provided by a traditional bank. They launched a wealth management platform recently, which is leveraging OneVest, another startup solution, and they'll be launching mortgages and other products soon. So the strategy here seems to be if Neo has you as a credit card customer, they can cross sell other products to you. They'll be able to capture a larger share of wallet, so more of the money you spend on financial services, and expand the value to provide our customer base. What's particularly interesting here is Neo is able to do this cost effectively and rapidly with limited risk by partnering with other providers. So the plus here, quick expansion, lots of products. Let's get more share of wallet. The downside is probably the actual revenue they make from these products or the gross margins is less because they're sharing with other people.
And let's talk about the launch specifically. What unique advantages did Neo have upon
So
launch?
very bold vision, needed lots of money to get this launch, need credibility with partners like Hudson Bay. Um, this founding team has experience with past success. They had previously co-founded and scaled Skip the Dishes, which you may have used if you across the country now.
Yeah.
That successful experience resulted in an $86 million exit and gave them the credibility to go raise money, and I think a bit of hunger and desire to build something more impactful and bigger. And that's what you're seeing here with Neo Financial.
And what does 1 million customers mean?
Well, in terms of financial valuation, apparently it means that why we're talking about this today is the company was able to raise 185 million Canadian at $1 billion valuation. Um, the round was led by Valor Ventures, which is Peter Thiel's fund. It's the third time they invested. They have participation from Tribe Capital, Altos Ventures, Blank Ventures, Ingalls, Maple VC, and Knollwood Advisory.
$1 billion valuation. What is that? What does that mean?
Well, let's be clear. It's Canadian. People are calling it a unicorn. I'm sorry. I refuse to call it a unicorn. But more important than the name or the valuation, the amount is, I think, assuming this round wasn't closed 4 or 5 months ago, and I don't think it was because there was a few other rounds announced in the last year for Neo. This is a strong endorsement by the investors. You're in a market right now, as we'll talk about later, where people are starting to conserve cash, valuations are getting suppressed, and you don't see many large rounds announced now. You probably, yesterday I saw on Twitter, there's more large layoffs being announced in large rounds. So this is a big endorsement. And I think what you can imply from this is that their financials are pretty good. What I mean by that, they're probably going really fast, that their customer acquisition cost strategy is working, it's very low, that you're seeing customer payback relatively quickly, and that probably by layering on these additional revenue streams, you're seeing newer customers be more valuable quicker. So it sounds like, my guess is this round and the valuation and the money implies that this company is doing super well.
And lastly, your takeaway for Canadian founders.
You should always be aiming to build a massive business, a massive opportunity. And lots of founders come, hey, I've got this huge vision. But to get there, you can't start there. Even these experienced founders that could raise a lot of money, you have to find a wedge, that initial entry point, and then use that to start your company, own that wedge, or so, like I heard someone yesterday, own that lily pad, and then go to other ones so you can get to that big vision. Second, the most undervalued thing by most founders is the customer relationship. Everyone values the technology. Here you have someone that values the customer relationship, says we're going to own them by offering a product they love, and that's the product we're going to go out there and start building a relationship. Then we're going to use other technologies and partners to expand that relationship. We don't have to build the technology. The core thing is owning the customer. And I think the last is, historically, our ecosystem says, oh my God, founders sold too early. Skip the dishes, $86 million exit. That if they stayed in the game, it could have been a $500 million exit or much bigger. Well, this company would not exist without that exit. So sometimes people need to take the chips off the table for whatever reason. And if it's success, they have a team, they have desire, and they have the capabilities now to go and building something bigger. So let's celebrate the wins when they happen.
Celebrate the wins. I love that. I appreciate your take on this news, Alex. If you like hearing Alex Norman's takes or you want to get them right to your inbox, then you need to subscribe to the TechTO newsletter. It's a great place to hear about our upcoming events and connect with others in our great community. Alex, speaking about maybe next week, a look ahead, what are you excited to read about?
Well, I'm excited for something we don't talk about every week. Wednesdays, we have a list of cool opportunities that we think people should go join for a career if they want to be part of a quick growing startup.
Yep.
And the reason I want to highlight that is I think in this environment, those cooler opportunities are not going to be as easy to find as before. So I just want to remind people, the team goes and looks at, okay, what startups we think are great, what startups have cool positions. So I just want to highlight that Wednesdays, we always have between 3 and 10 opportunities that you may have not known about.
Yeah. If you want to see those opportunities, you can subscribe at techtio.org/newsletter. Alex, onto the Shopify news now, expanding into delivery to challenge Amazon. Haven't they already beat Amazon in a sense?
Well, I think there was an narrative a couple of years ago around Shopify, arming the rebels in the fight against Amazon, that they would get, people realized that Amazon was the big bad, player in the e-commerce ecosystem, and that Shopify was getting all the companies that didn't want to share any data with Amazon. Well, Amazon's not a company that takes stuff easy. And a couple of weeks ago, they announced this thing called Amazon Pay. And what does it do? It enables vendors using other platforms, including Shopify, to have a pay with Amazon button. And that button lets me check out using my Prime account. And then Amazon will ship goods from one of their warehouse and logistic warehouses in like it was like Prime purchase on Amazon. So this is actually seems very innocent and not threatening. But what Amazon is doing there is they're letting someone else do the website, and they're capturing lots of value because they're now processing a credit card, and they're storing the goods, and they're shipping the goods. that's quite a bit of revenue they're taking away from third parties. In particular, if you look at Shopify's growth, a lot of it has been driven by the Pay with Shopify feature.
Yep.
So now you may have a Shopify customer loses 5, 10, 15%, or Shopify loses 5, 10, 15% of the payment processing to Amazon. It's can make a significant impact.
So a little bit of like crossover happening now. So
Yeah.
how is Shopify reacting?
Well, it's not like Shopify is immediately reacting to this. For a while, they've realized, hey, we've got this great digital goods and digital ecosystem, but how else can we help our rebels? We need to provide a warehouse and logistics experience that can match or surpass what Amazon offers. So let's enable our merchants to be smart about where they store the stuff across the North America, get it to customers quicker, and lower the cost of doing this. And the benefit from Shopify doing that is it increases revenues, keep and at the expense of lower margins for those revenues. So that's how Shopify was already this strategy we're going before this news.
So this week specifically, Shopify did something to improve its logistics infrastructure. So yeah, what did they do?
So they announced they were acquiring, I think yesterday they announced they were acquiring a company called Deliver for 2.1 billion US dollars for 1.6 billion in cash and 420 million in Shopify stock. That's a lot of cash. That's I think about 25% of the cash they have on their balance sheet. They will be combining Deliver with Shopify, their Shopify fulfillment network. And it's actually their second acquisition in the logistics fulfillment space because they had previously purchased 6 River Systems for about 450 million. So you can see they're investing in buying companies.
Yeah. And for those who don't know, what is Deliver?
So the company was founded in 2017. It had historically raised, let's call it, about $500 million, with the last valuation of the company around $2 billion. And what they do is they use predictive analytics and machine learning to rent out warehouse spaces and use warehouses' fulfillment departments to pick and pack e-commerce orders, anticipate the demand of orders based on geography and other variables, and basically tell vendors or merchants where to pre-position the products. So what you've got here, it's basically software that partners with warehouses to provide information and data to merchants to better create like Amazon-like experience. So it's like Airbnb warehouses with much more smart intelligence to help your customers out.
So two-parter question, was this a win for Deliver investors? And also, does this help with Shopify strategy? What does it say about their strategy?
Is it a win? Maybe. For late stage investors, they invested $2 billion, they're getting 2.1 billion out. So maybe they have a small type, maybe they have some liquidation preferences. So it's hard to tell, but it doesn't seem like it's a big venture-like outcome for them. And because of that, it may not be a big venture-like outcome for early investors. I'm sure the earliest investors and founders did okay, but we don't know what the terms of any of these rounds are beyond the financial disclosure of what, how much was invested at roughly what price. Because let's say the last stage investors got 3 times their investment and they took half the outcome away, and maybe there's a big escrow. So not clear. For Shopify, this definitely plays in a strategy and a strategy they have to win. It helps Shopify further diversify revenue by growing its logistics warehouse revenues. Its margins will most likely fall, and its CapEx requirements may continue to increase because you're talking about atoms, not bits. So software, you can replicate itself, and maybe Deliver replicates itself, but it seems like this software is going to be used to do more warehouse partnerships. The flip side is part of the strategy is it'll probably lower churn and lock in customers better. And what's interesting here is Shopify has decided it either has to move really quickly or it would be more expensive to do this themselves. So it's better to acquire than build. So has this helped Shopify with its strategy? I think it has. I think it's accelerated it. And if they made this decision, they probably felt it was better to buy than build.
And last question on this, what can the TechTO community take away?
You have to continuously reinvent your company. It's never done. You talk about product market fit, you can lose product market fit. Product market fit might taper out, so you might have to put another layer of revenue on. Your competitors in the market's not staying still, so your job of of building a strategy and executing against it never ends. Uh, Software companies like focusing on gross margins because they're very nice, they're very high, but it may make you vulnerable here. Um, the world of atoms, is lower margin, but having these warehouses and the ability to do logistics is essential to Shopify's future. And for many reasons, the lower margins are needed to maintain the higher margins. Uh, Buying may be best way to execute a strategy, and with the current environment, you may be more of a viable strategy than building just compared to 6 months ago. And finally, when you hear those headline numbers and around, it's hard to really judge what they mean without seeing all the terms. And I think that's going to be more true now than ever.
So thank you, Alex. So I want to hit on something that you mentioned in our first story about how there's been a lot of anytime that there's a round, we have seen layoffs, which kind of ties into our next story, which about Bonsai proactively focusing on the future, but unfortunately needing to lay off about a third of their team. So can you dive a little bit more into the news and maybe why they chose to do this?
Yeah, so like you said, Bonsai laid off 29 employees this week, a month after raising an A round.
Mm-hmm.
Um, what Bonsai says, it wants to refocus the company on growth and felt that its current product was good enough, and by lowering headcount, it could focus on funding growth. Basically, this cut provides it with additional time and capital to iterate on its go-to-market strategy and any future product iterations they need. So they bought themselves time and they bought themselves capital to invest in growth, which may be marketing or sales down the road.
Right. Why would they change their strategy after raising?
The company claims it has nothing to do with results, and I believe it. What it has to do, I think, with is they're looking around and the funding environment changed. I don't know what the valuation last round is. I don't know any of their metrics, but my guess, if they were to go raise now, those metrics would not support their current valuation. And with the current uncertainty in the market, you don't know even what if valuations and metrics fall. Like if a company used to get raised at 10 times revenue, and these are not the right numbers, and now it's going to be reset at 5 times revenue, you may have a company that raised a month ago, perform like they said they would, double or triple revenue, but it's hard to raise at a higher valuation. And you want to raise at a higher valuation because otherwise employees, their stock options are not worth anything. It creates a lot of headaches. So what's changed is the environment, and people are saying, okay, there's a huge amount of uncertainty, valuations are changed. Let's get ourselves more time to show we can grow consistently, to show that we can have good unit economics. Now it's only growth at all costs. It's growth with the ability to make cash flow or eventually have cash flow, a path to it. And let's grow into a valuation at a lower multiple. So the company's proactively buying itself more time and focusing on improving its numbers is what I see here.
And we have seen this a lot already, but do you think we'll see more of this?
Yes. How long this will happen, I'm not sure. I'd say usually historically we've seen patterns when things get tough. It's tough for 24, 36 months. The one big difference right now is we have a lot of what I call dry powder. So a lot of VC funds raise a lot of money, and those investors have to deploy capital. So I don't know where it'll go, but and as a founder, there's two ways to deal with this uncertainty. One is ignore the fact and hope that all that dry powder means that this is a short blip, and when you go raise in 12 to 18 months, it'll be just like it was 4 months ago. Alternative is to stop building anything that isn't essential, extend your runway, and focus on building a company that has strong fundamentals and can be venture scale at the same time.
This is obviously like a tough thing for any company to have to go through, and tough on the folks that unfortunately are out of a job. But is there anything positive in your opinion about this?
3 things for the ecosystem. Maybe more people will start companies. The opportunity cost is lower. For founders, it may be easier, more affordable to build your team than it was a few months ago. For employees, you may be able to get better option packages that companies are more likely to give you an exit in the future, make those stocks valuable or options valuable.
And takeaway for the TechTO community on this.
If you can raise money now on decent terms, do it now. Give yourself that war chest, extend that runway. Don't build stuff you don't need. For employees, when you change companies, think like an investor. Try to understand that unit economics of the company. If they will share it, try to understand how long a runway they have. And finally, don't panic. Valuations are down. It's tough right now, but 2021 was not sustainable. Valuations were a bit out of whack. We are going to swing a bit negative. What happens is you swing too positive, you swing back too negative, and then eventually get back to where we should be. So right now, we're probably going to swing to negative. Hopefully, it won't be long, and we'll be back to the positive scenario soon.
Yeah, hope to see that as well. Big week this week in Canadian tech. We have another big week coming up next week. You can meet Alex and I on Wednesday, May 11th at Stacked Market at our Summer Social Series. Really looking forward to that one. As always, like and subscribe wherever you're listening to Quick Takes. We will be back at our normal time next week on Thursday, and we'll see you on the inside.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be in the next multi-billion-dollar idea.
So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.